Hey everyone, in today's video, I'm going to be tearing apart 8 tax myths that millions of people believe. Some myths can cost you thousands of dollars if you trust them. And I'm going to give you the truth back straight from the IRS for 2026. Let's go. Myth number one: I don't have to file if I make under a certain amount. If you don't make much money, you don't have to file a tax return. Here's the truth: that's not always true. The IRS sets filing requirements based on your income, filing status, age, and type of income. Even low income taxpayers may still need to file, especially if they had self employment income, want a refund, or qualify for credits like the EITC or child tax credits. Here's a fact: some people with very low income still benefit by filing to get a refund or credits they may qualify for. So, myth number two: I can deduct every business expense I want. Myth: you can write off anything you buy for your business. Here's the truth: the IRS allows ordinary and necessary business deductions, but that's a high standard. Ordinary is common in your trade, and necessary is helpful and appropriate. Luxury items, personal expenses, or purchases not clearly tied to your business can be disallowed. Always separate your personal versus your business expenses. Example: a gym membership isn't deductible just because you work there a lot. IRS guidelines: only specific expenses directly tied to your trade service are deductible, nothing else. Myth number three: if I ignore the IRS, they'll forget about me. The IRS will forget about me if I ignore the letters and don't file. Here's the truth: no, the IRS does not just forget. If you don't file a return, the IRS may file a substitute for the return on your behalf, with no deductions and no exemptions, usually resulting in a bigger tax bill. Penalties and interest continue to accumulate, and ignoring notices may make it worse, not better. IRS rule: the failure to file and failure to pay penalties can stack up and grow daily. Myth number four: getting an audit means you did something wrong. An audit always means you cheated on your taxes. The truth is, audits are not automatic punishments. The IRS selects returns for audits based on statistic formulas, data mismatches, not guilt. Many audits are random, and they're triggered by simple reporting differences, like a form that didn't match the IRS records. Most issues can be resolved without documentation. An audit does not automatically mean fraud. Myth number five, and my favorite: I can claim my pet as a dependent. If I'm financially supporting my pet, I can claim them as a dependent. Truth: you cannot claim your dog, cat, lizard, iguana, or any pet as a dependent on your tax return. The IRS strictly defines dependent as qualifying humans, children, or relatives with specific criteria. Sorry, Fluffy, you're adorable, but you're not a tax deduction. Dependents must be US citizens or residents, lived with you, and didn't provide more than half of their own support. Myth number six: the IRS won't tax my side hustle. You only pay taxes on full time income, not side gigs. Truth: your side hustle income is taxable. Whether you sold stuff online, did freelance work, gig economy jobs, or content creation, if you made money, the IRS considers it taxable unless a specific exclusion applies. Even if you don't get a 1099, the income still counts. Plus, if net self employment income is 400 or more, you also owe self employment tax, Social Security, and Medicare. Myth number seven, which is a big one: I don't have to report cash income. Cash income is off the books. The truth: whatever your customer paid you, cash, check, Venmo, PayPal, gift card, it's still income. The form of payment doesn't change your obligation to report it on your tax return. IRS rules all income is taxable unless the law specifically says it isn't. Myth number 8: I can just file an extension and forget about it. Filing an extension means I have more time to pay. This is also a big one and a huge misunderstanding. An extension gives you more time to file your return, but not more time to pay. The IRS expects you to estimate and pay what you owe by the original due date. If you don't, you'll incur late payments, penalties, interest from the original due date. So it's very, very important to make sure your taxes are paid by the due date, not the extension. So here are the takeaways, verifications. Don't trust tax myths. Rely on IRS rules. File if required. Even low income taxpayers might benefit. Separate your personal versus your business deductions. They must be legitimate. Always respond to IRS notices. All truths above are backed by current IRS guidelines on filing requirements, penalties, deductions, and reporting standards, straight from the IRS.gov. So, if you learned something new and want more tax strategies and myth bustings, hit that like button, subscribe, and drop your biggest tax myth in the comments. I might feature it in the next video. Thanks for watching and see you soon.